Hello kids, this is your very own accounting teacher Adeel Paperwala. Welcome to my YouTube channel. Before watching this particular video, remember if you want to achieve excellence in accounting, you can also opt to enjoy my live classes for O-levels, IGCSE, AS and AT. If you want to study at your own pace, you can also opt to acquire my live recorded online classes as well.
Welcome to this explainer where we're going to tackle a really common issue for any business. What happens when customers don't pay their bills? We're going to break down two really important ideas. First, what we call irrecoverable debts, which is when you know for certain that money is gone for good. And then we'll look at doubtful debts. That's when you have a pretty strong feeling you might not get paid. Getting this right in your accounts is absolutely crucial. So here's our roadmap for this session. We're going to start with those definite losses, the irrecoverable debts, and exactly how to record them. We'll even cover the weird situation when a debt you've written off suddenly gets paid. After that, we'll get into the art of estimation with something called a provision for doubtful debts. We'll look at how you manage that from year to year, and then we'll wrap it all up with a nice clean summary of everything you need to remember. Alright, let's jump right in. We'll start with the most straightforward scenario, an irrecoverable debt. This is when there's absolutely no question about it. A customer is not going to pay you, and we have to officially account for that loss. Okay, so what exactly is an irrecoverable debt? Well, you'll often hear it called a bad debt. It's basically any amount that a credit customer owes you that you now know for a fact you'll never collect. Maybe they've gone bankrupt or just disappeared. The key thing to remember is that this now becomes a business expense for you in the current period. Accounting for this is a two-stage process, and it's really logical when you break it down. Stage 1 is the write-off. We need to get that customer's debt off our books. So we debit a new account called bad debts expense to record the loss, and we credit trade receivables to reduce the total amount customers owe us. Then, at the end of the year, we do stage 2. We close that expense account by transferring the total amount over to the income statement. That's what ultimately reduces our profit. Now, this is a huge point, especially for your exams. The bad debts expense account is what we call a temporary account. It's only there to collect all the bad debts for 1 year. Once it's done its job, and we've moved the total to the income statement, its balance goes back to zero, ready for the next year. Okay, so theory is great, but let's make this real. Walking through an actual example is the best way to see how these journal entries play out in the ledger accounts. So, have a look at this T account. On the debit side, the left side, you can see each individual bad debt being recorded as it happens throughout the year. We've got Amit's debt, Salman's, and so on. They all add up. Then, look at the very last entry on December 31st. We credit the account with a total of 3150, which makes the account balance to zero. That same amount then gets debited to the income statement as our total bad debt expense for the year. And here's another really practical point. Sometimes you get some of the money back. Let's say a customer owes you $1,500, but you only manage to recover $200. Well, you don't write off the whole $1,500. You record the $200 you received, and then the bad debt expense is only for the remaining $1,300. That's the actual amount you lost. Okay, now for a fun twist. What happens if, say, next year, a customer you had completely written off suddenly has a change of heart or fortune and decides to pay you? Well, you can't just put the cash in the bank because as far as your accounting records are concerned, that customer doesn't owe you anything anymore. So, the first step is to reopen their account. Then you can record the cash payment against that account. And finally, and this is the best part, that money gets transferred to the income statement as other income, which actually increases your profit for the year. This table lays it out so clearly. An irrecoverable debt is an expense. It reduces your profit. A bad debt that gets recovered is income. It increases your profit. And look at the timing. The expense is recorded when the debt goes bad, but the income is only recorded when you actually get the cash. They're perfect opposites. Right. So far, we've only talked about losses we know for sure have happened. But what about losses that might happen in the future? This is where we move away from certainty and into estimation. And this is all guided by a really important accounting idea called the prudence concept, which basically tells us to be cautious and prepare for potential losses ahead of time. So we create what's called a provision for doubtful debts. It's just an educated guess. We look at everyone who owes us money and estimate a percentage that we think, based on experience, we probably won't collect. Now, you'll see this term contra asset account. Don't let it scare you. All it means is that it's an account that reduces the value of an asset, in this case, our trade receivables, to give a more realistic picture. So, why do we even bother with this? Well, it's all about honesty in our financial statements. By making this provision, we're recognizing a potential future loss now. This stops us from overstating our profits for the year, and it also means the value of our assets, our receivables, is much more realistic. We're not fooling ourselves into thinking every single dollar is coming back. An estimate isn't something you can just set and forget, right? Every year, you have to look at it again and see if it's still accurate. So let's talk about how we maintain this provision over time. This is probably the most important rule to remember about provisions. In the very first year you create it, the entire amount of the provision is an expense. Simple enough. But in every year after that, you don't expense the whole thing again. Instead, you only record the change. You figure out what the new provision should be, compare it to last year's, and that difference is what hits your income statement. This chart makes that rule really easy to see. If you need to increase your provision, maybe you're more worried about bad debts this year, that increase is an expense. But if things are looking good and you can decrease your provision, that decrease is actually treated as income. Your level of risk directly impacts your profit. And here's where it all comes together on your statement of financial position. Under current assets, you'll show the total gross amount your customers owe you. Right below that, you subtract the closing balance of your provision. The final number, the net trade receivables, is the figure that shows what you actually realistically expect to collect. Whew, okay, we've covered a lot of ground there. So let's take a moment to pull everything together and focus on the absolute key takeaways, the things you really need to have locked in. This table is your best friend. It's so simple. Look at the pattern. Anything that represents a loss or an increased risk of loss is an expense, and it will decrease your profit. That's your actual bad debts and any increase in your provision. On the flip side, anything that represents a gain or a decreased risk is income, and it will increase your profit. It's that straightforward. So let's end with something to think about. This whole process isn't just about getting the numbers right for an exam. How a company handles its bad and doubtful debts has a massive impact on its real-world decisions. It affects who they give credit to, how they manage their cash, and even their overall strategy for growth. It's a perfect example of how accounting isn't just about recording the past, it's about shaping the future.